All right, ladies and gentlemen, good morning and welcome back to the Simple Markets channel. My name is JB and it is about 9 a.m. in Eastern Standard Time. I had a good workout this morning. I showered, I ate my breakfast, and it is now time for a YouTube video going over our strategy that we use here. And most importantly, a singular time frame trading strategy. Now, what this means is I simply operate on the 4-hour time frame. I do not use multi-time frame analysis, and yes, I do understand the importance of it, but I simply rely on an edge in a consistent method using one time frame because I find it to be more simple, and something that is more simple is easier to execute in the longer term. For those of you that are struggling with multi-time frame analysis, this video could be for you, or at least some insight into why I think a singular time frame is beneficial. A lot of you may struggle with the discretionary aspects of trading, especially those of you in the smart money space like myself. And I think that limiting your amount of time frames that you use could not only drastically simplify the trading plan, but it'll psychologically help you stick to that trading plan even easier in the long run. And most of you know this, but if you go in the description below, you can download the strategy entirely for free. You put your email in, it'll send it right there with the download link. Today, we won't be going too much into the individual watch list because, as I've mentioned before, this is mainly a recommendation. You can trade as little or as many pairs as you feel like. Keep in mind, the less pairs you trade, you may make less returns in the longer run trading the 4-hour strategy. If you want to drop your time frame to the 1 hour or the 15-minute, I also would recommend maybe limiting these amount of pairs because it can get quite hectic with the amount of trades. But most importantly today, we are going to be talking about the entry checklist. Now, the higher time frame bias, this is the part that is written as optional here, and I myself do not even use, and this is where that singular time frame really comes into play. Are you bullish or bearish based on your higher time frame bias? You can establish this based on the trend. Keeping it simple and consistent is key. I myself literally look at the chart on the 4-hour time frame and say, are we going up or down? Like I said, the more simple and consistent you keep it, the easier it'll be in the longer term on your trading psychology, but also to maintain your consistency as well. If you're a trader out there who finds themselves doing really good for a few weeks and then terrible for 2 months, followed by another good week and then another terrible 2 months, that consistency can stem a lot from psychology as well as just not having a simple enough trading plan for you to execute. So keep something as mechanical as this in mind. Number 2 is just simply a sweep on liquidity. The significance of the sweep can vary. More aggressive traders can take weaker sweeps for more trades, but a lower win rate. Conservative traders can focus on the highest quality sweeps, but they will get less trades overall and a higher win rate. A little side note here, a higher win rate but less trades is actually typically going to make less profit than a lower win rate but more trades. This is just due to the law of large numbers, and the more repetitions you get, typically the more profit you are going to make in the longer term, despite the win rate being slightly lower or marginally lower than that person using a more conservative approach. I myself would be someone who's considered a little bit more conservative with this strategy. We have some students who take hundreds of trades with this strategy in a year, compared to me just averaging about 140 so at the current time. And the third step in the trading plan is going to be displacement. Now, this is just simply a strong break of structure in the direction of your trade, and it creates a fair value gap when breaking structure. This just kind of shows high volume in the markets, and a strong break of structure just shows us that we are aligned with the proper higher time frame bias. This rule combined with this one as well is kind of why we are able to operate on a singular time frame without issue. And then the most mechanical entry we can do is throwing a Fibonacci at the 75% level and just entering based on that range. Targets and TP and trade management can be seen here. And if you do download this document, there's plenty more information for you to absorb. But without further ado, we are going to hop over to my trading journal here. We'll talk about some of these trades and then we're going to hop on TradingView and review them. So as we can see for the whole year, this is my equity curve using that same strategy that is downloadable below. I have a fairly consistent equity curve over the course of the whole year, and about 90% returns is what I'm sitting at the current moment, with about 48 RR. I do risk 2% per trade, so that total gain is extrapolated a bit, compared to about a 45% gain if I was risking 1%, which is a massive return of about 4% per month. And the more comfortable you get, the more you can risk, depending on your broker and leverage, of course. The overall win rate I have is about 61.48%. That includes my break-even trades that I take here because I do use a break-even rule. If I click on this column here and I remove this equal sign, this now tells me all of the trades that I've actually won versus the ones that are break-even, which means that about 40% of my trades actually run to that full 3 RRTP, and I've lost about 52 trades in this year total, which is extremely highly profitable, as you can see by the equity curve here in the results. We're going to hop down to my current month of October. We're going to leave out NZD CAD. That was a trade that I technically took in September and it closed out in October. We're going to start here with USD Chef that I took on the 8th, and we're going to drop down and go through these 6 trades. Hopping over to TradingView now, trade number 1 is going to be USD Chef. Now, we talked about simply looking at a bias and looking, is the chart going up or down? For me personally, I just saw some high bullish volume and then a strong break of structure to the upside. Following the rules that we needed to see, we don't have the clearest sweep on liquidity here, but realistically speaking, this is a consolidation range that price moved heavily and aggressively through, grabbing that liquidity and breaking structure to the upside. We then have a huge fair value gap right around that entry level, which works out well as we throw the Fibonacci on there and enter at the 75%. We came very, very close to my entry here and then got some bullish volume. I held strong. Price tapped me in eventually, and then we kind of consolidated for a little while here before eventually making that last bullish move to take me out at take profit here for an overall gain of about 3 RR, or on my account with 2% risk, it was just under 6%. The second trade we will look at here was not as generous to me. Now, this was Euro AUD. Once again, just simply looking at price and saw we were forming lower lows and lower highs in a bearish trend. I saw a break of structure to the downside with a good fair value gap and once again some consolidation before a wick that takes out that area and then breaks structure lower. Now I simply take my fib, I draw it from the high here to the low here when we are in a bearish range. You can see that's how I got my entry level. And then price worked its way back up and we had an aggressive news event that occurred on this date of the 10th. There was some political event that occurred on the date of the 10th, causing these ridiculous movements in price action, and price very aggressively destroys that stop loss there, and I took a negative 2% on this trade. Despite the news event occurring, although there was some trades in here that you will see got very aggressively stopped out, it also helped me reach TP on a few. So the next trade we will go over here is AUD USD. Now, AUD USD, very simply in almost the same way, we have an overall bearish trend on the higher time frame. We came back up, consolidated for a while, and then broke structure lower. We swept the liquidity of these highs here before breaking that low. We have a good fair value gap in that range. Once again, all the rules are met, so I simply take the trade. I don't sit here and question anything about the higher time frame premium or discount, or maybe this could have been a break of structure, so maybe we're bullish here and we're going to break this high. Or the fact that this consolidation was kind of sideways and we didn't really have the greatest liquidity sweep here. If my rules are met, I take the trade and that's what creates my edge. I understand the more repetitions I take, the better I will do in the long run. I simply set this order here, price tapped me in. Very quickly and aggressively, we move towards my risk-free level, which is this 0.5 line here, which means my EA or my trade assistant on my broker will take my stop loss and automatically move it just above that break-even level. So when price eventually worked its way back up towards our entry level, I did get stopped out here for a slight bit of profit, and then price ran very aggressively towards my take profit after that. So although this may look like a 3R TP here, this was a 0% gain on my account. This is where the rules of risk management come into play. Of course, I've shown you guys before that using break-even has been more beneficial for me than not using it, although that gap is starting to close. By the end of the year, I will show you guys the final result of this and show you if the break-even rule was better or worse for me. However, spoiler alert, we have so much tested data showing that the break-even rule is more beneficial for someone like myself with a more conservative approach. Next up on the list is going to be my next winning trade, which was Euro NZD. We just see price super aggressively moving to the upside, a clear bullish trend. Over in this area, we did not really have any strong or significant lows or highs in the market. We just kind of had some low and slow volume moving upward and upward. We then had a pullback that occurred in the market, and then as soon as I saw this high broke, we are now back aligned with that bullish momentum that I expected. So I took that very aggressive break of structure, the sweep on liquidity, once again that fair value gap in the range, giving me all the go ahead to set my order at the 75% level here, stop loss at the low, TP at the high. We very quickly got some momentum swiping me out at risk free here, but then price came extremely close to my level again for break even, but didn't quite get there due to spread. And then very quickly after that, we see that news event once again aggressively running me towards that take profit level for another 3 RR gain. So for those of you keeping tabs so far, we have one winner on USD Chef, one loss on Euro AUD, one break even on AUD USD, one winner on Euro NZD, and we're going to hop over here to AUD Chef, which was unfortunately another aggressive scenario with a loss due to that news event. Do I care and blame the person who came out with the news event because they made me lose 2 trades? Of course not. Do I go and change my strategy to avoid news events because this occurred once or twice in this 5-trade sequence? Of course not. I understand that operating on the 4-hour time frame, there's very little news events that'll cause this type of volume. It's part of the reason I prefer it. I don't have to follow Forex factory news events or high impact news and worry about my orders being stopped out like this on an intraday basis, especially those of you trading on that 15-minute time frame or lower. We have a break of structure to the upside after seeing a clear bullish trend. We have a fair value gap within that range as always, and my sweep of liquidity was not the cleanest here, but as I mentioned in past videos, if I see a clear bullish trend in structure breaking to the upside, I'm perfectly fine with taking that trade because I understand that the more repetitions I get overall, the more chances, the more profit I will make in the long run. That's the advantage of having that mathematical or statistical advantage over the market, is that if you have a strong edge or you have a proven system, the more trades and the more reps you take, the more profit you will make. I set my order once again at that 75% level and price just aggressively ripped through that low, taking my stop loss out for about a negative 2% gain. And then last but not least, we have pound NZD here, which is another example of the break-even rule stopping me out early, despite some solid analysis. We have a break of structure to the upside here. We have a fair value gap in the range. I got tapped into the trade here. Although this did not reach that 0.5% level, there is spread on a live broker, and that spread is known as the difference between the bid and the ask price. And when that opens or widens, especially on some NZD pairs, I did end up getting taken out at risk-free here, and then price worked its way back down to my break-even level. For once again, no harm, no foul, but just a small gain over that 0%. And then price super aggressively moved towards that take profit, almost reaching it, and then eventually went and ran it a few days later. So overall, in this trade sequence, we had 2 wins, 2 losses, and 2 break-even trades. As you can see, this is another month where that break-even rule seems to be hurting more than helping, but that's why we keep that long-term data to really get that long-term perspective of how the edge is playing out. We've had significantly worse drawdowns this year, and we could see the significant growth periods after. If we took a line of best fit and drew it from 0% to 90, you could see there will definitely be periods where we dipped below that, but then of course that leads to those hyper growth periods after where we now climb above it. This is statistically how a trading edge should work. Overall, you're going to have an expected value to win over the long term. There will be low and slow periods of growth like this, followed by extremely hyper growth periods like this that typically average out to that expected value of return. I hope you guys enjoyed the video. I hope you learned something from the trade breakdown. As always, you can download that strategy that we use in the description. And if you have any questions, DM me on Discord at jbladesdell729. It'll be listed here on your screen before the video ends. If you enjoyed this type of content, like the video. Thank you for watching, and I will see you guys in next week's video.